All right, so finishing this up, again, gift cards, you defer revenue liability till they're used, meaning redeemed, or the likelihood of redemption is viewed as remote. Sometimes people get gift cards as a gift and they just lose them or lose track of them or whatever. They never use them. And so the longer it goes, even though many of times these gift cards are never expire, if it goes for several years since the gift card was sold, um, then at that point the gift card, whoever the gift card is with, say it's with Target, um, they have to make a call on whether or not the likelihood of redemption is viewed as remote. And once that's done, they can recognize revenue uh, on those sale of gift cards. So anytime the gift cards redeemed, they can recognize revenue, or if the likelihood of redemption is viewed as remote. So here, NOAA sells gift cards redeemable for NOAA products, either in-store or online. During 2018, NOAA sold $6 million of gift cards, and $5,400,000 of the gift cards were redeemed for products. As of December 1, 2018, 450,000 of the remaining gift cards had passed the date at which NOAA concludes that the gift cards will never be redeemed. How much gift card revenue should NOAA recognize in 2018? Well, certainly the 5,400,000, but also the 450, right? All right, disclosure. Lots of disclosure, as they mentioned at the start of this lecture. Um, on the income statement, you've got to list stuff. So, in addition to revenue in its income statement, the seller is also required to either include in the income statement or disclosure notes any bad debt expense and any interest revenue or interest expense associated with significant financing components of long-term contracts. As far as balance sheet is concerned, um, and so contract liabilities are the same thing as deferred revenues. Contract assets. Well, what is a contract asset? Uh, well, it says if the seller satisfies a performance obligation, but payment depends on something other than the passage of time, the seller recognizes a contract asset. And so, for example, construction companies sometimes complete a significant amount of work prior to when the construction contract indicates they can bill. And so, as we'll see in part C of this chapter, a construction company in this situation reports a contract asset called construction in progress in excess of billings to reflect the amount that they'll bill sometime in the future. And of course, if the seller satisfies a performance obligation before the customer has paid for it, you record a contract asset. And of course, the most common contract asset is an accounts receivable. Disclosure notes. So here you have to separate revenue into categories that help the investors understand the nature, amount, timing, and any uncertainty of revenues and cash flows. Categories might include product lines, regions, types of customers, or types of contracts. Sellers should also describe any outstanding performance obligation, discuss any performance obligation typically, how performance obligations typically are satisfied, and describe any important contractual provisions like payment terms, policies for refunds, returns, and warranties. Also must disclose any significant judgments used to estimate transaction prices, to allocate transaction prices to performance obligation, and to determine when performance obligations have been satisfied. Sellers must also explain significant changes in contract assets and contract liabilities during the period. And so, again, why are you giving all this information? To give the users as much information as possible to give full disclosure. So here's just kind of a summary of things we talked about. Look over those if you want. All right, so that concludes part B. I know that was long.